Okay, welcome everyone. Welcome to building a trading plan and really taking an idea into profit. This material is prepared for general guidance only, does not constitute financial product advice, does not take into account your investment objectives or financial needs, so you must consult a licensed advisor before acting on any information you may see or hear. What we really want to talk about is just simple, workable, simple trading plans, really, and I'm going to define some of the components of the trading plan. I'll be doing lots of drawing on the screen tonight and then look at just building some rules around that. So one of the ways that we can approach the market is with a 60-day high scan. This is something that I talk about incessantly during the year, and also deviations of that, 50 days and 30 days, that type of thing. Have a look. We're going to have a look at a simple RSI and CCI as they work together. Going to discuss swing points, inside days and the gap along the way, and I might have a quick look at Ichimoku, time permitting, and I want to go through Ivan's concepts of these promise up, promise down bars. And Ivan produces a barrage of statistics to support his evidence, but I just want to go through a very simple look at how they can be made to work into a very simple trading plan. On the FP Markets website, last year we conducted a portfolio in real time based around $100,000, and all of the buy sells and the reasoning behind it are still on the website there. It's the first portfolio we did, and the point I wanted to make with this slide was that we simply listed out all the buys and sells and the dates and that type of thing. This is a bit of a snapshot of part of it, or just a snapshot of part of it, not all of it. And you can see down here in the right hand column, not so much as a brag, but as an outcome, we had some fairly big wins in there as a component of $100,000, and we were using 5% of the portfolio as margin to create a position size. Now it's a little bit out there to do that, but that's what we're using, and we produced some fairly interesting profits along the way, as it went along. And at the same time, we also produced some losses, of course. In fact, the portfolio had 47 losses and about 17 wins in total, and we ended up about 34% higher. So this year we're doing the same thing. On the FP Markets website, there's a portfolio in there, and it's called Portfolio 2, and this time we're using a smaller amount, $10,000. It's essentially the boss's money. I've got some money off Matt to put in there and to run it inside FP. It's done live, it's done with real money in real time. And again, we had a pretty tough start getting it going. It is based on some very simple observations of the market. Currently it's about 5% ahead in its outcome, and on Monday I closed pretty much all of the positions that we had in there except one, except TPP. But again, down here with the score is actually a little higher than that, I think now. The market, we've had 10 losses and only 6 wins, and yet we're 4% up, I think nearly 5% up today. So I want to go through just the concepts, just the way I see the market, and the way you might sort of build a guideline for yourself around that. So this is available. It's on the website. It's under this education research. It's here in the portfolio, and I think you might have to log in to the website. Not too sure. The other place to find trading ideas, of course, is I put out one every day in the morning newsletter, but also if you're trading the US markets, this year we looked at a site called Finviz, finviz.com, It is an excellent site for if you're trading, looking at the US markets along the way. It is a brilliant site for basically scanning. There's a little thing up here called a screener, and I won't go through it too much now, but essentially in the top here there's three different areas: a descriptive area, fundamental area, and a technical area. And we can also select an exchange that you want to scan through, and it's quite a nifty little tool. Sometimes we wish we had one as comprehensive as this for the Australian market. But descriptive, you can look for some fundamentals along the way. You can sort by price, give it price parameters that you want to look through. So anything over $5, and it will sort everything and then come into the fundamentals. In here there's you can look through EPS and PE ratios and various other things. Then in the technical area down here we just go for a simple 50-day new high. 50-day new high, and I think that's really all we kind of want there. There's candlestick, it'll scan for candlestick patterns and so on, but it'll give you a list of stocks that you can go through. There's about 400 odd there at the moment, but you can keep adding parameters to bring that down, and you can end up with 20 or 30. And it's not a bad place to start if you're looking at the US markets. So when we begin with this, we really want to write down how this is going to be managed, and once you build a very simple outlook to the market, because there's a concept, there's a kind of a thing where people think that this whole thing is a bit of a conspiracy theory, and it's actually not. When you see what really occurs at the high end of the market, like the institutional level of the market, this is not a conspiracy theory. They're all in there to do their best, and there's so many players in the market in Australia and around the world that still play in our market as well. So we really want to understand how we're going to manage what we're going to do, and once you bed that down, once you get that guideline down, it really doesn't require any trading psychology at all. It just requires a belief in your plan. You know, your plan has to be something that you can simply prove, and it's very, very simple to do, and I want to really sort of take that on tonight. So when we look at trends, this is my favorite thing. No one gets away from a webinar with me without going through trend. Trends are can be viewed in all time frames. They occur in all time frames, and we always start out here with the weekly trend, and we can see the series of higher highs and higher lows, and they become the trend over time. And within these movements into the high and then back into the low, I can get my little pen out. These high areas here and back into the lows and back out to the highs, we're really looking for the market to trade over a previous high and trends unfold. So if you're a long-term investor, you're really looking out this end of the market and looking for this type of price action. When you break this down, we have these areas like this becomes what's called a secondary market, and these areas here become the impulsive part of the move, or a primary move, as I call it. So these very large areas, very large movements become the primary part of the market. And you'll see, I'll just go back here, you'll see on the opposite side, once you start to view downtrends, you'll see that the very large moves, of course, to the downside, and recognize that and you're almost halfway home. Within trends, sorry, my little text just got over the writing there, but within these trends, as I was saying, that you have these secondary market areas. There's one here, there's another one here, and all these little areas here, secondary markets where the congestion areas, prices consolidate, what have you. When you break this down into different time frames, we're looking at the weekly trend here. when you look inside this area here, this first area here that I've circled, and look at it in a daily trend, you get what would be considered a daily downtrend, lower highs and lower lows in a daily downtrend, and the down candles are much stronger than the up candles along the way. It becomes quite confused. It becomes almost shooting yourself in the foot, where you have a trend going in one direction, this trend going in this direction, this daily trend going down, but the overall weekly trend going up. You can't survive on one time frame. There really must be two time frames to give a large picture and a small picture along the way. Part of the concept that we've looked at this year incessantly, and we will continue to do so in the future, are these pivot points. There's a very you'll find these at every single turning point in the market. The market can't turn without one, and I've got a textbook picture here of what they look like, where we have the market is heading down through here, series of lower highs and lower lows, bar by bar, lower highs and lower lows, and eventually the market makes a low, and we never really know which bar is going to make the low, but eventually the market makes the low. And then in the next trading period, whether it's an hour or a day or a week or a month, the next bar, when a bar makes a higher low and closes above the high of the bar that makes the low. So it must close above the high of the bar that makes the low. You have a pivot point in place, and all being well, there'll be some follow through. And the same on the high side of the market. As markets move up, you end up at some point with a bar that makes the high, and then we're looking for a close that is lower than the low of the bar that makes the high. These three candles in here, these three bars in here, confirm our pivot. Now what happens after that is up to Mr. Market, but essentially that confirms our pivot. Where this is going essentially is this graphic here, and I've used this graphic a number of times this year as well, is this little picture here really is what we're up against, if you like, for want of a better word. When we take a view of the market, we can have all of the information up to the point where we create a trade or create a buy position in the market in this case. So in here we have an entry point, we have a couple of indicators, whatever they are, they might give us a little bit of confirmation, but we've got a nice outside day, up day here, and we've set a stop loss. Fine, so that's all we can do up until this point. What happens after that is really is not a function of us anymore, and this is where people take it upon themselves quite incorrectly, that it's not a function of us what occurs after this. What occurs after this is really up to the market, but what we want is a high probability setup. So this doesn't work. This actual concept of willing things to work doesn't actually, I'm here to tell you from experience, it doesn't actually work. What happens after the position is taken is that the market does what the market does, and it's up to us to already have in place a series of guidelines about how to deal with what is coming to us in the future. And price action is coming at us in the future. So we ask ourselves then, well, what's the game around this? And the game, like any game, it's really about just working out the odds. What are the odds of something occurring? And working with those odds, you can build a rule-based approach to the market, which doesn't require any trading psychology. You know, I find it stunning that seems to be the answer to people who step up to the market and find it a little more difficult than what they thought. They think, oh, it's psychology. Well, no, it's actually they haven't got a trading plan, and they actually haven't got any guidelines for what they're actually doing. So the game is understanding the risk and reward of stock movement along the way. In this example here, and I've used this a number of times this year as well, in this example here there's two processes going on. One process produces zeros, the other process produces X's. So there's something occurring here that doesn't change and simply is rigid and has fixed itself just to simply produce X's down here and simply produce zeros up here. So the next one that comes out will actually be here, will actually be a zero, and the next one will be an X, because there's something going on that only produces that outcome. And then we get a little bit more artistic with it and say, well, this is now producing a pattern, 0x, 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 so on. And so the next one, because we have so much information here, there's a pretty good chance we're going to get an X on this side and a 0 down here as a continuation of this. So we get a bit more adventurous, and we have these patterns again with a 0xx, 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 and so on. And down the bottom here, 3 zeros and an X, 3 zeros and an X. But it's pretty reliable along here. There's no game in this, and so the next part of this would simply be 2 X's, and here would be 3 zeros type of thing, and off it would keep going. Then we get to the really interesting bit where we have these patterns here with a 0xx, 0x, 0x, 0, xxx, 0, 4 X's, 3 zeros, x0. So when we get to this part, which is where the market is, we've now got a market, there really is a question mark about what's going to come out of there next, and it's this not knowing what's coming out of there next is really what holds a lot of people back. But we'll take a different view of this. So this might be referred to as random outcome. It could be quite random what occurs in the next series of spaces next series of events going out here. But there's one thing that traders fail to notice with this, or fail to take on board and look to build a set of rules around, is that there, my little lines have moved a bit, but we can see that there is, in whatever's occurring in here, it can produce 4 zeros, and here it can produce 7 zeros, and here it can produce 3 zeros. And the top one can produce 3 X's and 4 X's along the way. So this is capable, whatever occurs out here is capable of producing a string of one thing, whatever that is, whether it's an X or a 0. But we're now involved with something that is capable of building a repeatable outcome on the right hand side. And that's what this is. This is this, we see in here areas like this in the market where the price action becomes sideways, a bit confused, and then suddenly the market breaks out and we get this string of movements along the way. And clearly this is what every trader wants. There's no doubt about that. Whether you're looking at the long side of the market or the short side of the market, it is this type of price action that clearly makes portfolios work, clearly makes trading accounts work. And it's dealing with this price action here that will save you so that you're still around when this turns up. And we can see from history they turn up from time to time, and that's what we really want in our outcome of building an understanding of our own trading rules. So the game is understanding the simple risk and reward of stock price movement. That's all it is. That's the game. So often market traders try and outthink the market and then make broad statements like it's going to go up. And that's about it's kind of like, well, how do you know that? You don't have any evidence of where anything is going to open tomorrow morning, or let alone close tomorrow afternoon in the market, in any market. No one does. So by saying it's going to go up is like saying, well, you know what's going to happen in the next 60 minutes or the next day. So we really kind of want to get away from that type of thinking. So we now have this introduced this risk-reward picture. This is something that we've used a lot this year as well. It is a very, very simple concept, and if you're still not understanding this, I would encourage you to email me and we can talk over the phone or something, but it is a very, very simple concept of risk and reward, and it is based around what you know at the beginning of a trade. And the only things that you know at the beginning of a trade is where your entry price is and where your stop loss is. So in the portfolios that we conducted last year and the one I'm conducting at the moment, I use the low of the entry candle. Whatever that candle is, I use the low of that candle. So that part of that part of the equation becomes my risk. This is equal to risk, and it becomes a percentage of the portfolio. So this risk value here becomes a percentage of the portfolio. If you choose to place your stop in a different place, like another range back, one candle back or two candles back, there's no problem with that. That's fine. But it also just simply becomes your R, what you're risking along the way. Anything that happens after that, whether the market simply in the next couple of trading ranges, if it simply moves down and stops you out, you know what percentage of your portfolio you have now handed over to the market. That's fine. So it becomes a game of percentages. If the market does what we would like it to do and move forward, then whatever happens up through here until we eventually exit for whatever reason, whether it's a stop loss up here, a trailing stop up here, or a time exit, or it's Friday afternoon, you don't want to hold a position over the weekend or something like that, whatever that distance is between here, here and here, becomes a factor of this. So if this here is 1, and for example this number in here, I'll use a nice round number, is 20 cents in here. If the exit is up here and with a profit of say 40 cents, if we've made a profit of 40 cents, then our R value, our exit value, is R2. It is 2 times what we risked along the way. It's a good way of measuring performance or measuring outcomes in your trading along the way. It's a very, very simple observation of the price and basically price profit analysis. So in money management, if we decide here we're $100,000, if we decide we're going to risk $1,000, 1% I should say, which is $1,000, we nominate the distance to stop loss in dollars and cents. So we nominate that on our entry point, whatever that is, we might nominate that we've got an entry here at the top of the range, and we know that our stop is here, which is 32 cents. Then we're willing to risk $1,000, 1% of our account. We simply divide the 32 into 1,000, and it will give us a position size of that stock or whatever we're looking at. It'll give us a position size. So if the trade goes pear-shaped and we end up taking a loss, we take out 1% of our account, and it takes this amount of stock or whatever it is that we're trading to do that. So it's simply a matter of managing your money around this percentage per trade. Now if you think about it, you would take, what it allows you to do is essentially take 100 losing trades in a row, and then you'll run out of money. If you stack probability on your side, and we'll go there in a moment, if we start to stack up an observation of the market, then that's actually quite hard to do. If you're trading a SPY futures contract, for example, the futures contract trades at $25 a point. on a $100,000 account. If you decide to risk 0.5%, $500, you nominate the distance to stop loss in points. If the distance to stop is 10 points at $25 per point, therefore 10 points equals $250, you divide what you're willing to risk by $250 and will give you a position of 2 contracts is your position size. So building a rule-based trading plan, we need to collect some data from the market to do it. Now, those that have tuned into Ivan's tutorials and some of mine along the way, Ivan is very, very big around collecting data from the market. I want to take a very simplified look at it for the moment, just to get it started. When markets again make highs and make lows and make highs and higher lows and higher highs, we have trend in place, and at some point these end and trends finish and simply reverse out of there. So a simple way of observing when to exit a big picture, if you're a big picture player, is when to exit something is simply when the trend changes. When the market starts to break lows and trades lower out on a weekly time-based big time frame, then you've got really an exit. And I'm always staggered by the amount of people that hold things like Slater and Gordon to the bottom, Dick Smith to the bottom, and stocks like that that are clearly trending down. And really, while they're sweating on this thing turning around, there's so much opportunity goes by elsewhere. As we said earlier, within markets there is, within primary phases, there are secondary, what we call secondary phases, where the price action becomes quite congested. And what I scan for quite a bit is essentially 60-day breakouts. And they're the sort of breakouts that come out through past these previous highs and continue on. Some of the work that Ivan's pushing, asking people to have a look at, one of the exercises that we did in the 3-week tutorial series was looking at what's called a promise bar. And I've worked with Ivan now for a number of years, and he made this statement some time ago about the market never breaks a promise. Unlike people, he said the market never breaks a promise. So what it was doing was simply identifying the bars that make a higher low down here on the left, make a higher low and a higher high, than the previous bar, the one exactly previous to it, and is a longer range than the previous bar. So 3 little criteria: higher high, higher low, and a longer range becomes what's called a promise up bar. And it's essentially a promise that the market will move higher. Was one concept. And then Ivan produced some statistics that said that within 1 bar, 2 bars, 3 bars after that, you can, if you work through your charts, and if we go over here to the right hand side, we can see as this market came down, there was a low in here, there was a pivot point formed, a true pivot point had formed, and the next day the market did trade. There was a promise up bar with a larger range than the previous one, higher low, higher high, and the next day it did trade higher and then failed. In the workings of the chart, when you go through these examples and find these bars, you will find that if you build a simple observation and say, okay, well, this is my entry and my stop is below that bar, so I'm stopped out down here somewhere, and unfortunate, but when you work through this and find that when you take an entry here and eventually get stopped out somewhere up in here on the reverse bar, down closed bar or something like that, you will find that this type of outcome will give you not more wins than losses, but larger wins than losses. So the winning size of the trade will become larger than the loss, and there'll be a number of losses along the way. It's inevitable. that will occur. And there are times over here, right over here on the left, where we had a promise up bar in here, higher low, higher high, larger range than the previous bar. If an order was placed across the top, it was never entered. The market didn't take that out, so there was no grief on this falling market. So a very, very simple concept of building predictable, somewhat predictable outcome, and it becomes that 00XX exercise. But the trigger is simply what's called a promise up bar. And this works exactly the same in reverse, is that you can find a promise down bar, which is a lower high and a lower low and a larger range than the previous bar. And there are times when you enter short into the market and it just simply sweeps you down through here until eventually somewhere in here you're stopped out for whatever reason, whether it be a Friday or whether you're expecting some news or something about the market has changed, and the positive side of this movement, when you catch one of these, far outweighs the potential for it to take a stop loss. And so what it does is point out to you very, very quickly that the secret to this, if anybody says there's a secret to this, is actually in the stop loss. It's not in the other side of the market. It's controlling the loss side of the market. But you need to find a high probability setup. So when you search around for promise up bars that occur after or create after pivot points in the market, you can build statistics around that, very, very simple statistics, and it's no more difficult than what I've just done here, where you simply print out the chart, get a pencil and a ruler and sit down and just pencil through the chart. Simple as that. Build some very, very simple statistics around what you're doing on the chart and prove to yourself that it works. If it doesn't work, then it doesn't work. That's the other concept about it. It may save you a bit of grief finding out that something doesn't actually work. An example of that is I had an idea in the gold market based around a 1 hour chart. It works on paper. We built an algorithm to see if it worked, and the algorithm can't make it work. Interesting outcome. So more work to do on that. So the other statement that was made many, many times in the tutorials was the outside period, and these areas here, this one up here, the outside period comes within comes within 1 to 3 bars of a high. It is also worth studying that statement to see if that's actually true or not, because you'll find in a lot of instances it is very, very true, and we saw that in the index this week. Let me just escape out of here and I'll come back to this. We saw that in the XJO this week. In the XJO, last week produced an outside bar here, an outside range, up close, but an outside range. It was just pip higher than a couple of weeks ago, but essentially it's brought this reversal in on the market itself. And you can see by, again, simple pencil work will do this, that an outside range really has a high probability of changing market directions. There's no two ways about that. So you'll see them, particularly in stocks along the way. You'll see one in Bellamy's exactly at the top is an outside bar, and it comes from the market not being sure where to go, and eventually it's decided by a break one way or the other. Okay. So these outside bars are very, very they turn up. They can turn up 10% of the time, turn up 20% of the time. They can turn up 5% of the time depending on the stock, but it does require you to pencil through. There's an outside period right at the bottom there, didn't trade any lower, and off we went. So it does require you just a little bit of pencil work, very, very simple pencil work, just to build up some statistics. So when you get hold of one of these types of movements along the way, you'll start to build a belief in. Now this is a larger time frame, this example I've got here, and within that time frame are the smaller time frames along the way, which you can then look at as exit strategies and further entry strategies and so on. But essentially I like to see a breakout. There is it is also worth doing the sums to see how often something breaks out and doesn't follow through. A very, very simple area to do as well. But simply a breakout and a series of higher lows and higher highs along the way until and then up there we have the outside period right there at the top. And down here we have one here at the bottom. So it's a very, very simplistic thing to do that will clear a lot of the noise away from when you're looking at charts and when you're looking through trading price action. When someone says, well, have a look at this chart, we'll really just break it down into its little components. One of the other things that we talk about quite a bit is RSI divergence. In the go-to box that's on your screen, there is a handout in there. There's two handouts in there. One of them, it was an article written by Ivan about RSI divergence, and I've got a couple of slides here. That will. This is out of that article you've got there, and it's very, very specific. It's very, very specific, and the reason I push along with Ivan's work a bit, because it's statistically proven. Ivan crunches the numbers and proves this whole thing out before he will write about it or print it. So the RSI divergence, particularly in market tops, as markets make a high up here, the market pushes up to 1 here, makes a high, pulls back, pushes again into the point at the high, and then pulls back again through there. So the market makes a high, comes back, makes a higher low I should say, and then makes a higher high out there. And we see down in the indicator the RSI makes a high as number 1 makes a high. The RSI makes a high here at 2, and then pulls back with the market as it does, moves around with the market, and then at number 6 it fails to make a new high, but the market makes a high. So we have this bearish divergence in there. This is an incredibly high probability reversal tool along the way. When you go and search through this, it is a very, very high probability reversal tool, but there are some very strict rules around it. So the market must have completed a movement up, a close, a higher close, and then a lower close. The RSI must register a reading above 70. So the RSI here must be above 70. So we've got our little 70 line here. The market must then move down 1 or more lower closes. The RSI must not register a reading below its equilibrium level. So the 50 level is down here. It must not swing down below 50. The market must then have one more movement up and exceed its previous close, which the market has up here at number 5, and the RSI must move above 70 level but should not go above the previous high. So it's called a swing failure, where it moves back above the 70 line and falls away. Now I had my example up here. Back in Iconics, back on the 24th of February this year, if you'd like to find one, there is a really nice example here. I've got two indicators here. I've got the CCI, which I'll come back to in a moment, but down the bottom is the RSI, this magenta line here, and we can see that the market made a high. We made a high in the RSI, we swung down, had a failure swing here as the market made a new high. So not an exact example, but that's the kind of thing that we're looking for for an RSI failure swing. And oops, and I think then yep, and then the market came down, and then the whole thing turned around as it does, swung down below the 50, and off we went again. So it's worthwhile looking at that type of. Someone emailed me the other day and said there was one in the XJO on the daily chart. We'll see if this is true. To be honest, I haven't looked at it before. Let's get it out. RSI here. No, as you see, we can see here that the middle part here is swung below the 50 line. So it's not true divergence, not true swing failure. It does need to stay above the 50 line. And the market's made a high here and made another high here, but this is not true swing failure as it's below the 50 line. It really has to stay above the 50 line. There's an example here that is true. This looks to be somewhat, maybe I need to do a bit more work, but maybe here high, then we've made a swing. No, it hasn't come up above the zeros. That's not true either. So it is but when you find them out there, they are extremely reliable as a reversal type of tool. So the RSI, one of the issues, of course, with indicators, you can simply view an RSI. I don't go for this idea of RSI overbought, oversold. I think the RSI over 50, over the equilibrium line, is very interesting. RSI falling below 50, I think, is more interesting if you're looking at the short side of the market. To be bullish on the market, the RSI really should be over the 50 level. Really one simple rule. You would look at long positions if the RSI swung over 50, as it has done here back on the 13th of April. When everyone thought the world was going to zero, the RSI swung here and swung up above the 50 line, and you had an expansion bar here as well, a promise up bar, and the market has moved higher. Just as an example here also, and I'll just highlight this on this promise thing, there's one in here as well, this bar up through here that was never crossed, but eventually 1, 2, 3, 4, 5, 6 bars later the market moved higher and took out that high. So Ivan states that the market never breaks a promise. There's another one in here, and it took 1, 2, 3, 4, 5, 6, and this bar here broke that high eventually. Now, it can't be the reason for staying in a trade that's not working, but it is a really interesting observation when you're setting up entry points into the market where you might set buy and buy orders, stop buy orders along the way. A very, very interesting setup. So the promise up bar and the RSI behind it. Okay, so the article is there. It's only a page and a half. It's easy read on the RSI. And he's got the example down here of swing failure on a upturn in the market as well, which would give you a buy signal into a long trade. But the notes are very, very, very specific there about this, around this 30 line and the equilibrium line. Pen. About this equilibrium line here at 50 and the 70 and the 30, how it reacts around this area here and reacts around this area up here. So it's quite specific about that. So CCI is something we also talk about incessantly, quite a bit. That means it is a simple reversion tool, a commodity channel index, a 20-period simple moving average is all it is. And I'll come back to my charts here. I'll use the index I've got up here. The blue line here, CCI, is essentially, if I put a 20 period average on here, yep, 20 period average. If I put a 20 period average on, this is over the XJO 200, 20 period moving average on here, as the price itself, as the market moves across a 20 period average, so does the CCI line cross the zero. So all it's effectively done is taken this average and flattened it out into a straight line, and then measures the distance that the closing price is away from the average. And as the closing price crosses over the 20 period average, so the CCI line crosses over zero. And you can see prices weakening out here as it comes back to the 20 period average, and this comes back to zero. Now it is simply, if you take the view that markets mean revert, that they swing around averages or swing around points, then this tool will tell you when it's basically heading back to that average. Now you need to also be a little bit careful with this tool because it's not a trend tool, it's a momentum tool. And even when markets are trending, losing momentum, as they have down through here, we can see that the average itself is falling away, but the CCI gives a buy signal, gives a crossing signal here above the zero, across the zero line, even while the average is pointing down. So it's not the universal tool. It does need to be used in context with the market. So you really want the average starting to swing up, and the market above this CCI above zero along the way. And here average coming down, flattening out and starting to turn up, and confirmation along here that everything is well so far. So it's now you can really work back through an application on a chart and say, okay, every time this crosses I'm a buyer, every time it crosses down I'm a seller. Did I make any money? How much did I make? And if I didn't make any money, how much did I lose? You add up all the wins, add up all the losses, and if you have your wins higher than your losses, you have a trading plan in 3 simple steps. But it does require a bit of pencil work, sitting at your desk and working through that. Okay, so the other component I was going to look at, sorry, I haven't got it open, just let me get it open, was a very, very quick look at Ichimoku and what the big deal around that is. Ichimoku is a Japanese indicator that a lot of people seem to want to use for trading. So I'll just go through the basics of this. There are some very nifty, very nifty observations to be made with this. It is not the be-all and end-all. It is just simply a tool. You do need to study it to really understand a little bit. But it is made up a couple of things. It's made up of 5 elements. The first one is the Shekau Span. It's simply the closing price, the current closing price here at the, get my pen out, simply the current closing price up here, closing price is here, and it's extended back 26 periods. So it's a closing price, it's just a line that follows the closing price around and is back 26 periods. And I just want to discard that. What all there is to notice with this is the previous price action was down through here, price has rallied up and done what it's done, but the current price, all it tells you is that if the Shekau Span is here, it is above the price it was 26 periods ago, or 26 days ago, or 26 weeks ago, or 26 hours ago if you're using on hourly charts, that type of thing. So it becomes just a looking at pricing context, saying, well, okay, we're above where we were 26 days ago. So it's looked at as a little bit of a momentum thing. So the Shekau Span is a current closing price shifted backwards. It allows the trader to see at a glance if the current price is above or below the price 26 periods ago. Well, it's for lazy people, I guess. As the Shekau Span represents a closing price, it also represents past support and resistance levels. So a bullish Shekau Span is above the price, a bearish Shekau Span is below the price, and a neutral Shekau Span is in the price. There's the Tenkan Sen. It is the highest and lowest price over the past 9 periods. So it takes the highest price up here and the lowest price from 9 periods ago, and simply adds that number, it divides it by 2, and you end up with the Tenkan Sen line. So it's then suggesting that as the price starts to flatten out, it also starts to flatten out, and in future may provide a level of support if the price comes down to that line. So 9 periods being short term may provide some short term support, is the Tenkan Sen line. Tenkan Sen and Cajon Sin measure short term trend and the short term support. Tenkan Sen is following the price, indicates that trend is strong. So Tenkan Sen is flat, the price is consolidating or not trending. First observation of the Tenkan Sen if the line is above or below the Cajon Sin. So I'll just go back there. So the Tenkan Sen here is the red line. It simply follows the price around, and as the price starts to consolidate, it flattens out in there, looking for a which would become, on observation, hopefully a support area. The Cajon Sin is the same. Cajon Sin is the highest and lowest price over the past 26 periods, so a wider range of periods. The Tenkan Sen was over 9, the Cajon Sin is over 26. So the highest price, lowest price divided by 2 gives you the value of the Cajon Sin. So as prices are rapidly advancing, it's like they're not referred to as averages, but they're simply saying that the Tenkan Sen over the Cajon Sin is quite bullish, as we can see here. And any retracement in price would first try and find support at the Tenkan Sen, and then that failing, the Cajon Sin on the way back. So the future cloud is shifted forward 26 periods, and the yellow line and the black line. So the future cloud, so when you set up your screens, if you're using Ichimoku, set up your screens so that you have at least enough room on the right hand edge of your screen that you can fit the cloud in as it's calculated forward. Some software doesn't project the cloud forward, that's no good, it has to be projected forward. The cloud is made up of 2 lines, Shekau Span A and Shekau Span B. Shekau Span A is a Tenkan Sen and the Cajon Sin divided by 2 and then shifted 26 periods into the future. So whatever value this is here, Tenkan Sen, Cajon Sin, it is these 2 values here divided by 2 and simply shifted into this period here in the future. So as this moves up through here, the halfway line, the Shekau Span A is calculated out and moves up with it. Now, the cloud is made up of 2 lines, the Shekau Span B. The B line is the highest and lowest price over the past 52 periods, so quite a long time back. It's also twice the 26 period Cajon Sin, I should say. So over 52 periods, so it's a long gathering of price over 52 periods, and it's high-low divided by 2 and shifted forward, and it becomes, I've got it marked here as the yellow line, and it is simply the longer term support and potential resistance on any future movements along the way. So Ichimoku and multiple time frame analysis, the high probability of trades occur when price finds support or resistance in multiple time frames on different elements of Ichimoku. Directional length of trend need to be considered for higher probability outcomes. Now just see if I can get it set up on my what we might do is take a look at it on the index. Just bear with me a second. Okay, got it here. Take the weekly chart out. So we have the weekly chart. It looks really untidy, I know, but once you work with it, it becomes quite easy to use. So we have a mixture of things going on here. We can see on the left-hand side back in December 2014 and early 2015, the price came down through the cloud and started to find support on the 52 period Shekau B line, and eventually came off there and rallied up into the highs. Following that, it really fell through the cloud. Once it's down through the cloud, it becomes a very bearish signal in the longer term, and we saw the price trade here below the cloud, and currently we've got the price back moving through the cloud. So we've got a couple of things going on. We can see that I'll get a bit of this noise off here. We can see that the Shekau Span here is above what it was 26 weeks ago. It's the closing price shifted back 26 weeks because we're using a weekly chart in this case. So the Shekau, this becomes our first, essentially our first inkling that there's something bullish going on. The second one is that the Tenkan Sen and the Cajon Sin have crossed here on here, and we've got our first support level here based on this at around 5,160. And with any weakness in this market based on Ichimoku cloud, would see the Shekau A line provide a little bit of support just here at 5,200 odd, 230 odd. A break of that, you would be looking for this Cajon Sin line, Tenkan Sen line I should say, to hold at that point here at 5,163. So a little bit in it, but it's quite a nifty tool to give you an overall bullish bearish view of the market. So currently we've got the price in the cloud. If we look at the daily chart with this tool, we can see that the future cloud, what's really quite important about the future cloud is the A line is actually above the B line. The B line is your longer term 52 day support in this case, and the A line is the distance between the Tenkan Sen, Cajon Sin projected forward. So this is considered to be a bullish cloud, particularly where it becomes very wide like this, in areas where it becomes wide. Areas where it's thin, it's very prone to break doesn't offer that much resistance to price breaking down. So we can see that the price has come through the cloud in the past. Tenkan Sen and Cajon Sin have crossed in positive territory, and our Shekau Span is above the price action itself. As we go forward here on the right hand side, it would start, our first real bearish signal would come if the Shekau Span entered into this price or below this price area down through here, and then the Tenkan Sen crosses over the Cajon Sin, red crosses over the green, and as the price moves back towards the cloud, you would have a very bearish, essentially top signal using Ichimoku. Now you can use this in all types of time frames, but we can see that the Cajon Sin here has basically provided support, and as it came through there, the Cajon Sin here provided support in the short term, and currently we're right on that support level of 5,303, and I think today we went to 5,306 on there. So the two elements are providing a little bit of support. So that really that's Ichimoku Cloud is simply a support resistance calculation based on the range of prices over a set period of time. Okay, I will leave that there. I will leave that there, and I will come back to this and come back to, where's my other one gone? Come back to this. So when we sit down, in all of the work that we've done this year with Ivan and all of the work that I've put through on the Monday morning outlook for the week, it is really based around observations of the market and simply sitting down. If you saw my desk at work, I've got charts and charts and charts and pencil lines and marked up bars and calculations of how many bars forward and that type of thing, and it just simply comes down to that opening up. If you're interested in a particular market, whether AUD, USD, or we did one on the pound the other day, all the charts are the same. You will find promise up bars in all of the charts. You'll find outside periods in all of the charts. You'll find the same elements across. You find the same elements across all markets, all types of markets. Human nature is the same. It doesn't matter what market's being traded. And I would encourage you to start to look at some very simple elements in charts and building an idea around them. Build an idea around that. One of the others, I'm going to finish in a moment. One of the others, as you know, is my the Haguro method that I put forward. Quite a number of times in here. I'll just point out again. We had a talk the other day about this line number 12. Line number 12 in a weekly chart is a shaven top, small shadow at the bottom, and the line says that there is, and it's a statement. So when found in a high price area, if the following week fails to trade above the midpoint and closes below the low line, this indicates a break in price. So it also says that there's a very strong probability of a green line appearing. So after this red line here, shaven top, small wick at the bottom, there's a strong probability of a green line appearing. So that's kind of a bit of a statement out there. When you find them in the particularly in low price areas, and there's one in ANZ here. This is a daily chart. Let me do this right. It's in a weekly chart. We can see, oops, let me take a few of these things off, and we can see here there is in the index in low price area down through here, one turned up, and the following week had this really almost engulfed it backwards in there. One turned up here on a week. Now you've got to think about that this is a week when a strong down close candle, everyone is short, and suddenly the next week it follows through because it's a promise down bar, it's a long range bar, high, lower, lower, low, follows through for a short amount of time and then simply reverses out of there and engulfs that period. It is a very, very nifty observation. So it's a statement. The idea is put an idea together, go and prove it on your charts. Does this work? Yes, no, and get the strike rate and write down how many times it happens and how many bars it follows through, and you build a little bit of statistics around. And number 12, my little number 12 says that if you see one of those, there is a high probability of a green bar appearing next to it. Well, so far we've done pretty well. I think there's one 2 in here, there's one here that hasn't worked, another one here that hasn't worked, and so on. But if you keep your stops, work out the best way to place a stop around that, you can build a trading plan out of that. So I'm going to leave that there. Are there any questions? And we can go and watch the state of origin. All good? I think we're all good. Oh, no questions. I must have done it well. Or you're all watching the footy. That's good. All right, thank you for that. I will just go back to here and just remind you that this is educational material prepared for general guidance only, does not constitute financial product advice, does not take into account your investment objectives, financial situation or particular needs, and you must consult a licensed advisor before acting on any information. So thank you for coming out, and good trading, and hope to see you soon.